Let's discuss trend lines. Trend lines are basically a way for you to help predict price because technical analysis is all based on future predictions. Now, trend lines, they have to hit those price points 2 or more times, and you can either have a positive trend line or an upward trend, or you can have a negative trend line, which is a negative or a downward trend. So let's take a look at the negative or the upward, also a positive trend, and show you how this works. So understanding that trend lines have to hit 2 or more points to create a trend line, what can happen here is as a stock is coming, if it hits this one point here on this trend line, that would be our first point that it hit the trend line. Then a stock can isolate here, can go back down. This would be our second point. It now created a trend line. This would be our third point. Again, the more points it hits, the stronger that trend line becomes. So this is on a positive or an upward trend line, so it's going in the up direction this way. Okay? You have the same thing in the negative direction. The negative direction or the downward trend line works in similar fashion. The stock's coming here, approaches, hits this point once, bounces off, comes back, hits it here, that's 2. Okay, as it's coming, it's wiggling. You can have it hitting third time, and so on and so forth. So this is basically the uptrend. This is the downward trend. And again, these are trend lines that just help you look at the future. So if you're looking to purchase that stock, this trend line extends all the way up to the future, and they can change. So say now all of a sudden I'm hitting 1 point and then I'm going here to 3. What this really does is now the elevation or the angle can be changed on that trend line. Okay, so the trend line doesn't have to continue always at that same angle. That angle can be changed at a higher slope or a lower slope. So it can incline or decline depending on how strong that trend is. Regarding trend line validation, because it takes multiple points to establish a trend line, it can be validated with a third or fourth point if a stock is moving away from the trend line. So let me show you an example. Let's say a stock's hitting here. This is our first time or first point that it hit. Stock's trading, isolating. This would be the second time it hit. Then the stock's going, it's coming back up, and now it's going away from this trend line. So now you can see it's not following this trend line anymore, but because this trend line still progresses into the future, it shows validation if this point comes back down, hits it, and bounces back up. So that would be our third point, and that third point creates the validation. So trend lines, the same thing goes in the negative direction. They help revalidate points, the more points that start hitting it, and as it goes away and comes back down to hit the trend line, that creates a validation point. You want to also make sure you pay close attention to trend line spacing. What I mean by that is the distance between each point that it's hitting. For example, let's say we have this trend line that's going in the upward pattern. It hits the point once right here, then it goes again, hits it twice, and now again a third time. As you can see, the space is fairly even between each one of these points. Now, if we had something really different or totally weirdly spaced, for example, I'm going to use a red marker to show you the difference. If I had kind of the same thing, hitting it once, then again going back up, hitting it twice over here, and then again a third time, that could be something that's in question because the distance is not as evenly spaced. And that becomes a problem with trend lines because there's not enough room to establish those price levels. So be very careful if the spacing is way bigger than it really should be or way larger. So they should be closer or tighter together if possible, and that really supports a little bit more, has more validity towards the trend line. Another thing to understand about trend lines is the angle of that trend line. The steeper the angle, the less validity support and resistance has. And the reason for that is because you're climbing through those price points so rapidly. So on this first trend line, basically I have 4 basic points that are also about similar distance apart. they're hitting it, and you can have support and resistance at the different peaks or the valleys. Now on the second one, the slope or the angle is so much greater, and because the angle is so much greater, that price movement is running through all the different prices a lot quicker. So for it to have support and resistance at this level or this level, it's very weak support and resistance. Support and resistance take time to build, and for it to build time, it has to go through a longer sequence or a slower slope. So with trend lines, this one would be a little bit more healthier or a little bit more stable versus this one. Yes, this one would make you quicker money, but as far as trend lines go, as far as support and resistance go, the validity of this second line or a higher angle slope is a lot worse than this one with a lower slope. So keep that in mind when looking at support and resistance. When you're looking at trend lines, remember that you have upward sloping trend lines and you have downward sloping trend lines. They both help you predict future prices within technical analysis. So keep an eye out on those few different key points when looking at trend lines.